Welcome to the weekly update. We'll go over the action in the market for the past week and then see how things look for the week of August 29th through September 2nd. And we saw a real shift, especially on Friday. The markets had been looking more positive. Our technical picture was still improving and actually starting to turn positive. Well, all of that changed pretty much on Friday when Fed Chair Powell came out and said, nope, 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 we're going to tackle inflation. And that is our biggest priority right now. We don't really care about the economy as a whole. I'm just paraphrasing. They do care. But we can't really worry about the economy until we get this handle on inflation. That means we're probably going to continue raising interest rates. And this scenario, for the second time now that the market had been developing, that maybe inflation had topped and was starting to come down, that got wiped out because this happened a few months back and it caught the markets off guard when the Fed did not pivot, because the Fed is really supposed to follow what the market is telling it. Well, this time the Fed is going in a different direction. So with the most recent economic reports that we've been seeing, we also started to see inflation coming back down. So we hit that low in June, bounced up off of it, went up to the 50-day moving average. That pretty much overshot the market at that point, and the S&P started to fall back. The markets really were in anticipation all week of what is Chair Powell going to say on Friday. And when he came out with a very hawkish stance, the markets just didn't like that, and we saw a pretty major decline, and that shifted our technical picture quite a bit. So let's go back and talk about the week. The main catalyst was the lead up to, which means all week. We were kind of quiet. We would have gap ups or gap downs, but the intraday action would be pretty calm for most of the day because the markets were waiting to see what was Fed Chair Powell going to say. This came out, it was a lot more hawkish, and we had a broad-based significant decline on Friday where pretty much everything was hit. That being the last trading day of the week, that also impacted our weekly charts. And we still have some positive areas, but things have shifted a little bit. And now we have to see, where does the market want to take things from here? So for the week, we ended up being down 4.04%. Over 3% of that was just in Friday's session. Volume continues to be below average. We're still in summer months. A lot of people are on vacation. Things tend to slow down. People are apprehensive. And when we get in that kind of an environment, volume really tapers off. The technicals, they're still showing a little bit of improvement on the weekly charts, but they're switching back more negative on the daily charts right now. Now, we could recover from that, but we just have to go with how things look for right now. Inflation and interest rates are the big concern and have been the concern overall. But we have another list of geopolitical concerns, the supply chain issues, oil, more Fed speak coming out, earnings that are hitting the markets. And then this debate going back and forth, whether are we in a recession? Just what is a recession? And depending on your definition, we are in a recession or we are not, and we can't get a lot of agreement on that. We are showing a weakening trend overall with our ADX, and I'll show you the chart of that, but it is a negative trend. Here's the intraday action, looking at a 10-minute bar chart. Way over on the left is Monday, and you can see it was pretty subdued. Any real move ups or move downs were not all that significant within the trading days. We saw a really nice up day on Thursday, and that looked to be setting things much more positive, especially coming into the close. One scenario that I was playing with is because the markets were quiet, they were leaning a little bit more negative. I thought earlier in the week that was sell the rumor. And then coming into the close, we saw some strength come in, and maybe the market was poising itself to buy the news. Kind of the opposite of what we see a lot of times, where it's buy the rumor, sell the news. Well, after we opened right in here, this is when Chair Powell started talking and was pretty aggressive with the remarks, and we just started to tank. We dropped down below S1, S2. We went even below S3, which doesn't happen all that much. And we ended up closing right at the low for the session. So it ended up being a pretty negative week. You've got a lot of folks really analyzing things right now, saying, yeah, this is what should be happening because stocks are still very overvalued. You have other folks saying, but look at the rotation we've been seeing from value back into growth. That still provides a positive backdrop. And what usually happens is that people try to take the stock market and make it black and white. Well, we're in a big bowl of gray right now. And so that's why we look at the charts and really study things from that angle to give us some clue as to what is the current condition and should we look to see the market go higher or is it in fact going to go lower? So for the week, all the major indexes, the Dow, the NASDAQ, and the S&P were down over 4%. Small caps, actually, they were down too, but not as much. They were down 2.9%. This is how things look over the last 5 trading days in August for this past week, where the Dow was actually down the most, followed by the NASDAQ 100 and the S&P, but all of the indexes showed declines. This is going back to the all-time high, showing how the Dow has fared the best longer term, even though it didn't this past week. And you have the NASDAQ and the NASDAQ 100 showing the highest amount of declines. Our sectors, everyone except energy was down on the week, and a lot of the usual areas, tech, discretionary communication, those are more growth areas, and they've been just hammered in 2022, and they were starting to recover. Well, everything pretty much shifted this last week, where energy had been doing well, then saw some weakness. Now it's kind of coming back more into the picture in a positive sense. And this just goes back the last 5 trading days to show how these sectors performed. Energy did the best, followed by materials, and then all of the other sectors ended up being down. I don't have current market valuations, most recent charts. They're not updated. Maybe they're on vacation. That's one of the reasons I'm actually recording this video a little later than usual. I kept going to their site, waiting for the charts to update, and they just weren't. And I wanted to get this recorded and posted. So I don't have any of those charts to show you this week. Sentiment after Friday's session, we had been more neutral, but now we're starting to drift more into the fear area. Now, we tend to use this when it gets to extremes. When everybody's really freaking out, that's when we're looking to go long, or we think the market has a chance of going up. When everybody's extremely greedy and the party's just never going to stop, that's when we're looking to get out or to go short at that point. We can often ride the sentiment wave as it's going one way or the other. Well, for most of the week, it was more in the neutral area. And now since we're tipping more over to fear, that could be more of a negative thing right now. And this just shows the historical chart of the fear and greed index. This is another one I ran across at Isabel Net. They're showing we're right about in the middle, but this chart is a couple of days old and it's before Friday's session. And it shows that we're pretty much in the middle. They call it the fear and frenzy sentiment index. I don't know a lot about this one or what goes into it, but it pretty much lines up with what we saw most of the week, this past week. With the Ridex bear bull ratio, it's also not giving us a real extreme reading right now. It did tick up, meaning folks are getting more into the bearish mutual funds rather than the bullish mutual funds. But we start to really watch this when we see a spike to the upside. That means people are really freaking out. Or if it gets really low, that means folks are getting very, very complacent and they think, oh, the market's always just going to go up. When it's in about the middle, it doesn't help us as much, but we can still see the overall direction of things. The active asset managers, again, this is older data now. It declined a little bit in the most recent post, and it will probably go down even more with the big decline that we saw on Friday. Consumer sentiment showed a little bit of improvement. That's the blue line, where the previous reading was all the way down to 50 and we bounced up to 58. That's still a very low reading, but compared to where we were, we are showing some improvement. But the 2-year treasury yield, that's red, it still continues to be very high and maybe getting ready to go even higher. So the spread between these two is pretty large right now, and that's what's measured down below. We like to see these readings together. They generally tend to go in the same direction, and they generally don't get this far apart. So everything's all out of whack right now. Either interest rates need to come down or people need to get happy. And either one of them don't seem all that likely currently. This could always change, but this just shows that things are pretty stretched right now. The Chicago Fed Financial Conditions Index still hanging in there. Now, this is a few days old. It was last updated on the 24th, but as long as we stay below this black line, that means that the economy is not getting too crazy from this measurement. Also, the spread between risky bonds and not as risky bonds, it continues to drop. And this was updated on Friday, so this is not showing any real panic currently. The probability of a recession, by looking at the yield curve, this is really starting to go up, but it's not as high as it has been before. Even though there has been other times when we've hit a recession at this level, this is the forecast of what they think will happen. The blue line is more based on numbers that have been released. And as this is going up, this just means there's more and more of a chance of this being a recession. And this is kind of interesting. A week ago in the last video, I showed this same chart and it said they're showing a lot of inflows. Well, this last week in European stocks, we're seeing an awful lot of outflows. We pay attention to Europe because a lot of times they tend to precede what happens in the US. Their inflation picture is a lot bleaker than in the US, and they are also anticipating it lasting longer, especially for a recession, than what they've been predicting. We can't even agree in the US what a recession is. Well, they do agree, more likely, in Europe, and they think that we're going to be in a recession for quite a while. So people are pulling their money out of stocks. And a large part of the moves that we saw this week tended to come on the heels of what happened during the European sessions. And so that's why we want to watch things, not only in the US, but watch what's going on in Europe as well. This is just showing heavy truck sales. When they get really high and then start to roll over, that can signal a real weakness in the economy. Are we starting to roll over now? It's rolling over a little bit, but this could turn and go back up, or it could continue to fall, and that would promote more of the recessionary scenario. Small caps are still, this is more positive, they're still historically cheap when you compare them to large caps. And that's what we're watching closely too, is what are the small cap indexes doing, because they are really undervalued. That's this blue line right here, lighter blue line, but they've been really underperforming large caps, so they might have some room to go up. When people get into small caps, that means that they're typically willing to get into more risky investments. They're feeling good about maybe their more boring investments, so they want to have a little adventure, and they might get into some small caps. If a lot of people are doing that, that can produce a lot of buy orders, which can provide support to the market. This is the chart I tried to refer to a moment ago. Last week's chart showed that we're seeing a huge inflow into tech. Well, they switched their story here, and now we're seeing an outflow of tech funds, where it's really dropping down here where we see the red circle. So you've got a schizophrenic market right now. This is what contributes to real GDP. Real GDP takes inflation into account. And we're at this section right here where we have negative GDP, the very last bar on the right. And it just shows that consumer spending, which has really been cutting back, but look at how much consumer spending has contributed. That's why I say retail sales and people buying things, that's a huge part of the US economy. Well, when you're having inflation, when you're having to worry about filling your gas tank, when you don't know what's going to be happening, maybe your rent is going to be raised, or if you have a mortgage and it's adjustable, or you're trying to get a mortgage, you're looking at significantly higher payments than what you would have been not so long ago. this is when people tend to really pull in the reins on their spending, and we can see this really start to shrink overall. This is the thing that's kind of making it a little bit more confusing, and we might get some insight into that because the upcoming Friday is the first Friday of the month, and we will get the employment situation report. That's what's been hanging in there. That's what the politicians are saying. Well, look, we can't be in a recession. Look at how good employment's doing right now. Well, that could change at any time, and we're going to be watching for that. And this red line just shows how we were able to really bounce out of the COVID low. And is that because of what happened during all of the lockdowns? Is that why we're seeing the real bounce? We don't know. I mean, people have their theories, they have their opinions. We're trying to look at hardcore facts here. Also, other things suggest that maybe people are getting more than one job. They kind of like this idea of working from home. And they thought, well, instead of being 8 hours at the office, I can get all my work done in 3 or 4 hours. I've got another 3 or 4 hours. Why don't I get another job and have another income? So that's been one thing that's kind of a phenomenon in certain areas. All right, let's look at some charts. With Friday's decline, we saw the VIX really spike up, both with the line chart and it also went up with the bar chart. This just shows that fear is coming back into the markets. The Ulcer Index, which we've been using even in the daily videos, it hasn't really turned back up yet. And in fact, the daily chart is starting to rise and it's coming up to its moving average, which is more indicative of what's really happening right now. So on this chart, we're not seeing a real pickup in fear. Where we are seeing fear start to increase on the daily chart. Copper, which had been really declining, is since been bouncing. That suggests that the economy might look better into the future. And then I'm not going to talk about the possible positive scenarios right now because of the shift, because of the big down day. Those scenarios are still there and they're still viable and they still could happen. But I'm not going to talk about them because the market still needs to sort itself out right now. But I do talk about those in the daily videos that I post pretty much each day. And there are some boring days where I just do a brief video between 5 and 10 minutes long, where other times I do a full-blown video and I go through the analysis of all the different charts. So I won't be discussing that in this video. On a valuation basis, the market is still considered to be very overvalued. And there's some other things that I've been looking at and that I don't show in the videos. Things like the rule of 20, if any of you are familiar with that, where you take the inflation rate and the current PE, and if it's over 20, that means that the market is overvalued. Well, that's suggesting that we are very overvalued. This is also suggesting that we have a current PE ratio of around 30, and the median and the mean should be between 16 and 17. Now, this is looking back, and the market doesn't do that. They justify it by looking forward. And so they're feeling a little bit better about things because the forward PE ratios don't look as scary. But we also want to get some historical context here. And this is suggesting that the market is still quite overvalued. And if that is true, that means either the price has to come down, meaning stocks and indexes will come down, or the earnings have to go up, or a combination of the two to get them more into historical norms. Also, FactSet, they must still be on their second week of a vacation because there wasn't any new blog posts put out there. This is kind of interesting too. On August 5th, we had a 68% chance that there was going to be a 0.75% rate hike at the September 21st meeting. Well, then we got some weaker economic data that came out and we dropped to 45%. Last week we were at 41%. Well, after Friday's session, we're back up to 61%. So this can jump around like a roller coaster as well. We are seeing a bit of a decrease with the Fed balance sheet as they go into their tapering or lessening or letting things expire and come off of their balance sheet. So it continues to roll over, and that's supposed to kick into an even higher gear coming in the near months from right now. So this should start to go down even more. Okay, looking at breadth, this was pretty negative overall. We saw a real decline based on price and volume. We're still above the moving average on both of these, but we did see some real recent weakness. The advanced decline ratio is really showing a decline, but we're still above zero. New highs, new lows. They are starting to turn down now. That's one of the things. When we saw the nice little run up from the June lows, we didn't necessarily see a real expansion of new highs. And that just showed that under the surface, there wasn't a lot of gas or wasn't a lot of extra power to take us through that 50-period moving average. And so we ended up going up to that level and then falling back. That's starting to turn more negative now on this chart. Accumulation distribution, we're still above the moving average, but we did see a decline. You can also see up here where volume is well below average. This blue line is just how I measure it. And when we're below that, we are below average volume. Our trend, we almost got to the point where the red line was going to cross below the green line and turn things positive. Not now. With that decline that we saw, it shifted the red line back up. But we are still seeing the ADX continuing to fall. Now, if you're more aggressive with this indicator, you might already be neutral, meaning that we're not in a trend right now as this continues to fall. If you are more conservative, you want to wait until this gets down below 20 and then turns back up. And then whatever line is on top, that is the trend that you go with. The Arun, pretty much flat on the week. It's showing a decrease in selling and also a decrease in buying. The mass index, we still have a signal that was generated here. It looked like it did a pretty good job of picking that June bottom, and then we shot up from that. We're starting to lose this signal a bit now. Every day or week that goes beyond means this signal has less and less validity behind it. So we can't really use that right now. But when this did generate a signal, after that, the S&P went up, because this just suggests something's going to happen, but it doesn't tell us the direction. Well, that might be in jeopardy right now. Some longer term look at things. Now, I'm starting a longer term look by looking at a daily chart. This is what I was really following. Each one of these bars is just one day rather than 1 week. We saw the really nice run up from the June lows, and we came all the way up to the 50-period moving average. And then we turned and we've been going down ever since then. Now, the Dow, the small caps, the mid caps, pretty much everything except the NASDAQ, they were able to get above their 50-period moving average, but the S&P was not. It's the real bellwether for the US stock market. We came up to that level and have been declining. On the daily chart, we're also starting to break through. This should be support rather than resistance. We broke through this support and we're coming down and we're slightly below the longer term support. So this is not looking all that positive right now. Now, it could always change, but we just have to go with what we see right now. This is the weekly chart looking at the pivot points where we were coming up nicely. Well, we're starting to come back down. And can the market stay above this S1 level, or is it going to fall through and continue to go down? We're below the 50-period simple moving average, so that is negative. The long-term trend still shows us that we're in a downtrend, and this is coming up to the 50-period moving average, which pretty much equates to a daily 200-day moving average, and how we came right up to that level and have since been retracing. Bullish percent index, after giving us a really nice high extreme positive reading, has been declining. The Chaikin oscillator coming up to a nice high level, but is now starting to show a decline. Chaikin money flow has been pretty much flat, but is now starting to look a little more negative. The force index, it's really hard to see, but it's barely gone negative right here. McClellan oscillator was giving us an extreme positive reading. Now it's shooting down below zero and is currently negative. The summation index based on price and volume are starting to go down. They're still above zero, but they're showing some current weakness. We are still seeing our oscillators. And again, I don't use oscillators on weekly charts very much. Doesn't mean I never use them, but I don't rely on them all that much. And the classic example right here is you can see all of these oscillators would have given us a negative divergence the whole run up through 2021. That's the reason why. Well, they're still looking pretty positive right now. So if you use these, you might get some hope from this. But with the decline, that really didn't get measured into these indicators. And so we'll really want to keep an eye on these to see if they show some improvement or if they start to roll over as well. Swindler trading oscillator, declining based on price and volume. We dropped below zero. The PMO, this is another oscillator. It actually shot up to an extreme positive reading, both based on price and volume, but might be starting to roll over. Our PMO studies show that we're extreme negative with those that are rising, declining with the buy signals, and rolling over with those PMOs that are above zero. RSI, we actually showed two overbought signals on the daily chart. We were only able to get above 50 with the weekly chart and have now turned down, and this is looking more negative. Special K, which is very long and takes a long time to turn, it still is positive overall. Stoke RSI, after going extreme positive, has now been dropping. Williams percent R, same thing, extreme positive and now dropping. The Vortex, this is still positive, but it's showing some weakness. It's picking up what happened on Friday. Ultimate Oscillator, after almost getting extreme positive, is now starting to decline. Money flow, same thing, starting to decline. Bollinger Bands are not really giving us an extreme reading. And I say Bollinger Bands, I should say percent B. This measures how close are we to one of the upper or lower bands of the Bollinger Bands. When we get to those levels, that means that we're moving pretty far, pretty fast, and we're pretty much at the midpoint right now. The KST is still showing some improvement. This is a longer-term oscillator that we can use to judge our trend. The PPO also having crossed over positive, but it's rolling over just a little bit. The rate of change going back 1 week is negative because we had a down week, and we are also seeing a bit of a decline going back 50 weeks, or roughly 1 year, with how things have changed based on where they were 50 weeks ago. The Copic curve, this could be positive. We had a pretty deep reading right here, and we're starting to go up. This is another indicator that doesn't necessarily tell us the direction. It just means something big could be happening. Now, when this actually crossed, we were setting the June lows at that point, and then the S&P started to go higher. We'll have to see, can that follow through, or will this end up being a false signal? And then we're still doing okay as far as our fib retracements on the weekly chart. We haven't come down to this 38.2% level, but we're also watching these moving averages. We came right up to the moving average and it's been falling back. Can we stay above this? Now, one thing that is positive is this is a 10-week moving average here. This is actually going up. So that's a little bit more positive as well and may end up providing some support. Our different charts looking more negative with the Heiken Ashi with a black bar. The Kegis still hanging in there positive. When they're black, that's positive. When they turn red, that's negative. The Renko is still looking okay. In our equivolume, going back 1 week, we see a real decline. And going back 14 weeks, it had been looking nice and positive, but is now pulling back. Point and figure, we don't have any signals that are generated, but we did add 4 new zeros, and that's down. So this is looking a little more negative. 3-line break, it hasn't picked up the decline from Friday yet, so this is still looking more positive. The Elder Impulse system has switched to a red bar, that's negative, and we've dropped below this moving average. The parabolic SAR, just to get you a little more confused, the dots are underneath, and that is positive. So we're seeing a negative sign here and a positive sign here. Broad market, just looking at the S&P, the mid caps, and the small caps, we're not seeing any real major divergences right now, either positive or negative. Looking at all stocks, they were trying to stage some kind of a comeback. Well, they've been showing some weakness now, and they're still in an overall downtrend. And now you're going to hear a lot of the same thing over and over. Mid caps, downtrend, trying to recover, falling back. Same thing with the small caps. Same thing with the Dow. The NASDAQ never did get up to its moving average, but it was staging a really nice recovery, but has since fallen back and is still in a downtrend, as is the NASDAQ 100, NYSE, the Wilshire, all of the indexes. FANG stocks were trying to make a bit of a comeback too, but really stalled. And we're down 2.88% on the week. ARC, which also was trying to make a comeback, it was down 4.14% for the week and is going back into some weakness right now. The biggest software companies of a weekly chart trying to make a comeback, but recent weakness. Here's Dow theory, where the Dow is showing a decline on the week. The trannies were down. Utilities are holding up a bit better, and they're actually outperforming both the Dow and the transports right now because they like a more high interest rate environment. CRB index, the weekly chart, still in an overall uptrend, had been falling back, but now is starting to climb higher. Gold, which you'd think gold would be at the moon already and on its way to Mars, but that's not really what's happening. In fact, we're seeing gold in an overall downtrend, and it was down even in Friday's session. And the same thing with silver. It's in an overall downtrend as well. Oil, and they're trying to keep oil under 90. That's become kind of an output as far as Saudi Arabia is concerned. If we can keep oil under 90, that will help keep gas prices either going down or not rising much more. But we're at 93.06 right now. The dollar, that's been doing about the best, where it's still outperforming and just screaming to high levels that we haven't seen in a long time. Looking at interest rates, it looked like bonds were forming a base and coming up out of that. Now that seems to be in jeopardy. And treasury yields, and this is a daily chart where through June, we were seeing an overall decline in interest rates, but then throughout August, we've seen interest rates starting to go back up. Overall, some of our relative studies showing that oil has been doing the best, followed by the dollar. Those were the two areas to be in so far, where gold, stocks, and bonds are negative going back to the beginning of the year. Bonds have been, on a weekly basis, they're outperforming stocks slightly, but they are still in an overall downtrend. Now we compare on a monthly chart, stocks are outperforming bonds overall. See, nice and confusing, isn't it? Gold has been really suffering as the dollar's been going up, so we're seeing this ratio really decline, and gold is even underperforming overall the S&P, but has seen a real bounce lately because of recent weakness in the S&P 500. Low volatility stocks are still performing much better and are in an overall uptrend. These are stocks that folks get into when they fear that the market's going to go down. Growth had been trying to make a bit of a comeback, but is now showing some weakness when compared to value. The NASDAQ 100, which is growth, compared to the S&P 500, which is growth and value, had been trying to come back, but is now showing some weakness. S&P 100, which again is mostly growth compared to the rest of the S&P, it has been underperforming on the weekly chart. Discretionary, which was also trying to make a comeback, well, it's now showing some weakness. Energy, which had been really strong, but then started to fall back, is now starting to go back up when compared to the tech sector. So what's our outlook? Well, we don't have any reports on Monday. And on Tuesday, we have consumer confidence. That's the big report coming out. And new home sales will be coming out. Then on Thursday, we have ISM manufacturing. That's going to be a biggie. So earlier in the week, we don't have a lot of economic data that the market can really grab onto. Nothing on Monday and nothing really significant on Wednesday. Then we'll have jobless claims again on Thursday. And then the big one is going to be the employment situation report on Friday. So we're watching the technicals. Some of them are looking positive. Some of them are showing some weakness. Some suggest that our valuations are doing okay. Others suggest that we're overvalued in the market right now. The scenario that inflation is topped and is starting to come down, which may mean that the Fed will pivot, that is off the table right now as the market fixates on inflation and interest rates. We still have all these geopolitical concerns, which could come to the forefront at any time. Supply chain issues, which could also feed into the overall growth scenario. Oil, it's bouncing around. Fed speak, there may be some blowover as everybody falls back and analyzes and pretends they know the answer with why Chair Powell said what he did the way he said it. And we're not really seeing a change in Fed policy right now. And then earnings are still coming out. And then we have a longer term kind of under the surface situation in Japan. And that's why their interest rates continue to be so low. That could come to the forefront at one point. We're just keeping an eye on it for right now because it's not really having an impact on the market. So our scenarios, looking at just Monday, we have to go with a down scenario. And this is based on the daily charts because of all the different reasons that I just mentioned. And the technicals are turning more negative, but we could be becoming short-term overbought. That might produce some kind of a bounce, or we still might have more room to fall before they become more extremely over, and that should be oversold, I'm sorry, but possibly oversold, not overbought. We can't really go with the up scenario now because of the negativity that we've been seeing. Our scenarios, our rotation, our setups, they're still there. They're still valid, but we're not really relying on them all that heavily right now. Technicals, we're losing some moving averages on the daily charts that we had regained. The biggest one is the 200-day simple moving average. That's the line in the sand between positive and negative. On a weekly chart, that would be a 50-period moving average. If we can't get above that, the market's not positive at that point. And then we're not necessarily sideways unless you use the ADX in a more aggressive manner, because both on the daily chart and on the weekly chart, we're seeing the ADX declining. It's not below 20 yet, but it is weakening right now. And it has turned negative on the daily charts. So thank you. I hope you found this useful. Not a lot of clarity right now. It's really foggy, but hopefully this will help you navigate through some things. And I still will be preparing at least a daily brief video every day. And when I see the need, I'll do a full-length daily video. I'll also do the weekly video next week, as well as the intermarket analysis video. So have a wonderful week, and I'll talk to you next time.